Hi, I'm Eric Ghysels. I'm a professor of economics at UNC-Chapel Hill, as well as a professor of finance at the Kenan-Flagler Business School, and I'm actually also in charge at the Kenan Institute of FinTech research. And so I'd like to talk to you today a little bit about an area of research pertaining to FinTech that I've been working on in the past year. It pertains to robo-investing investment advice. This is the use of artificial intelligence to do basically wealth management, asset allocation. It's becoming more and more popular on Wall Street to have sort of machines decide on which assets to buy and sell. So I'd like to talk to you a little bit about that. And the work, I chosen the title Artificial Intelligence or AI Alter Egos. Let me tell you what I mean by that. We have a rather unique data set of about 23,000 brokerage accounts that are basically investors over roughly a 10-year period. We follow all their trades. We have basically all the details of their investment activities. And what we do is for each investor, we create a shadow artificial intelligent robo-investor. Namely, what really is specific here about this notion is that whatever the stocks or ETFs that an investor looked at over the past 2 years, the robo-investor also has as the possible set of stocks and ETFs to invest in. But the robo-investor is going to use some of the latest developments in AI to make allocations decisions. And it's a 10-year period, so there's a lot of time span here, which is also unique. So it's a deep cross-section with people that some of them don't have a high school degree, some of them have high school, and most of them have a university degree, but it's a relatively rich cross-section. We have measures of risk aversion that come from surveys for each of our investors. So we have a lot of their characteristics, individual characteristics. And the results are really remarkable and confirming what most people think will happen in the industry. Namely, the low-income people, the relatively less financial literate people, the high risk averse people, they gain a lot from the investment robo-advising alternative. They would have for up to sometimes 4% annual return increases comparing their performance with that of the robo-investor. Now, what is also remarkable that is over this 10-year period, in the middle of our sample, we actually have the financial crisis. And one thing that the robo-investor can do is they can pull out of the market and go basically cash when they don't really find much investment opportunities. And that is a key to the success of this AI in the sense that these AI algorithms, they use not only firm-specific information, but also macro data. They look at default risk, they look at interest rates and things like that. And based on that, what we see is they tend to not invest in ETFs or stocks at the onset of the financial crisis, whereas our individuals suffer, I would say, what's called behavioral biases, notably the disposition effect, the fact that people tend to sell winners too fast and hang on to losing stocks too long. And that really hurts, in particular, in the midst of a financial crisis. So this research covers a lot of things in terms of which type of algorithms actually work. There are a number of algorithms out there that are being advanced in the industry, and some of them really are not worth your money, actually. We're also showing that some of the claims that are made about what is good about robo-advising for large swaths of the population, people who have very little savings and cannot afford the expensive fees of wealth management. Indeed, that is a really viable alternative that is very inexpensive. And we also look at ultimately the global AI, the investment robots that use the entire universe of stocks, and we sort of measure what most people are under-diversified. They only have a very few number of stocks. We also sort of measure what gains can be made, and here again, which algorithms kind of work and which don't. If you want to find out more, go to my blog on AI alter egos. I'm Eric Ghysels, and I thank you.